Hi and welcome to this week's Property Insider video. Today Dr. Andrew Wilson and I discuss the house price rises that are occurring across Australia and what's going to happen moving forward. You've probably already found out that Westpac Bank has upgraded its forecast, predicting 10% rise this year as well as next year. There are some issues with that which we're going to discuss as we break down their forecasts. We're also going to talk about the glut of apartments in the CBDs, what that's doing to prices, what that's doing to rents. Dr. Wilson will give his thoughts on the latest employment figures. So if you want to keep up to date with our regular weekly property commentary, please subscribe to this YouTube channel and click the little bell icon so you're kept up to date when each week our shows come out. House prices continued rising throughout the month of February, and this week yet another big bank, Westpac, upgraded its housing market forecast, joining the long line of economists that have done a 180-degree about-face. The bank said that surging momentum in our property markets and leading indicators, things like finance approval, job creation, consumer confidence, all pointed to strong house price growth moving forward. In fact, the bank predicted that dwelling prices will rise 20% over the next 2 years. Well, to get a better understanding of what's really going on in our housing markets now and how this will play out moving forward, I'm looking forward to my weekly chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Good day, Michael. Yes, another interesting week.
Yes, it was. Well, Westpac lifted its forecast for dwelling prices. They say they're going to go up 10% in 2021 this year, another 10% in 2022. And the bank then expects the property boom to flatten out in 2023. In a couple of years' time, they think rising fixed-term interest rates combined with prudential measures aimed at reining in what's then going to be, I guess, a bit of a property boom is going to slow down our markets. They also believe, and I think we've both suggested this, that over the next year there's going to be a rebalancing, that investors are going to start getting in the market because currently they're still taking a back seat. Investor lending accounted for less than 25% of home loans over the second half of last year, and that's going to rise as it does every property cycle. So what are your thoughts on their forecasts, Andrew?
Well, I'm feeling dizzy, Michael. You know, it's up, it's down, it's a boom, it's a bust. But I guess without trying to be too cheeky, at least that horizon's long enough for what I believe will be the eventual revision to these forecasts. I was a little interested or bemused at the numbers that Westpac promoted. Got to remember, these are forecasts for all dwellings, that is units and houses, and they're very strong numbers at 10% annually. I'm not sure we're going to get that sort of growth for various reasons in the unit market. I think the unit market will be a bit of a drag on the overall market this year. We're already seeing some very clear signs of that with inner city unit prices down quite sharply recently, Michael. So I think that'll be a drag on overall prices growth. I certainly think that there's 10% in Melbourne and Sydney for house price growth. Interesting that Westpac were a little negative on Melbourne's growth this year. Melbourne started off with a real head of steam, even though it did have the 5-day lockdown last week. Melbourne will shrug that off now the shutdown's finished, and it'll be up and running sooner rather than later. And also there were other, I guess, predictions that were, I thought, a little problematic. Adelaide, I'm not sure Adelaide will get a double-figure prices growth this year, again, including units, which are a softer market in Adelaide. And they're quite bullish on Perth, which I think is quite reasonable, and also Hobart. But yeah, look, I think we may see some revisions going forward in those projections. And I'm also interested in next year's projections being just as strong as this year. So it's interesting. We don't really see year-to-year cyclical growth being the same. Markets are either really rising or falling, Michael, in trend from year to year. So it is very unusual to see, I guess, the same predictions for 2021 and then followed up with 2022 in a number of these Westpac forecasts. But anyway, look, the future will reveal itself as it does sooner rather than later. But I do think that 2022 will be a much, much flatter year than 2021 overall, Michael. We just don't have the energy, lower rates or higher incomes to keep pushing up prices by double-figure rates year on year. And I think that we're just catching up this year. And when we do catch up, and I think that'll be by the end of the year, and, maybe even sooner than that, then the market will just fizzle out.
One of the points you made was that it's an overall price forecast, and that's the wrong way to handle it, because some people are going to read this and think, I can just buy any property in Melbourne, Sydney, Adelaide, Perth, and it's going to go up 10%. That's not really the case. You've got to get down more granular. But let's just have a look at the extraordinary results that were received again last weekend in our red hot auction markets all around Australia, Andrew.
Yeah, every capital city above 80%, Michael. I'm not sure we've ever had that before, particularly Brisbane. Can you believe Brisbane?
Yes.
That's just mind-boggling. We're used to saying, oh, yeah, 50% in Brisbane. That's a good result. Now we're getting the sort of Sydney and Melbourne boom results in Brisbane now. Now, numbers are a little low, Michael, compared to a year ago in auction numbers in Brisbane, but that is quite a change in their auction climate to be getting those very high clearance rates. And as I said, it's really right across the board now. And look, Melbourne bounced back, didn't really fall, to be quite honest, just under 80% again. So this is a red hot auction market. This weekend is interesting, Michael. It's the weekend before the Melbourne Labor Day holiday. Typically, we have a very, very big weekend of auctions. It's called the first Super Saturday of the year in Melbourne. But really, buyer appetite has shown no sense of waning this year so far. Bring it on. The more properties, the more sales there are, and clearance rates. And we're going to see some really strong prices growth over the March quarter, I believe, as a signal of this. Now, just on that, Michael, I think that one of the other interesting aspects that's being revealed now is that listing numbers just seem to be tapering off a bit, new listing numbers. And that may be either the greed factor from sellers wanting to wait for prices to be higher before they go into the market. But I think that might be it. But it'll be interesting to see if that's trend, of course, enhanced by the Melbourne shutdown last week, but whether that trend continues with fewer new listings coming into the market as a sign of sellers holding back, or whether there's something more significant in the market.
Well, Andrew, I've been reading that people are moving to the country, they're moving to regional areas. No, they're not. I've been out at auctions, and while there may be a few people there, look where they are. They're coming to auctions, they're coming to open for inspections in all our capital cities. The capital city markets are really hot. There's no shortage of buyers there, are there?
No, and look, it's a good story, the regional exodus story, Michael. I'm sure when the day, and look, there's always lots of qualifications for those that are promoting this regional boom. The numbers that are really sort of driving that are the latest ABS regional population growth data. I guess the numbers that were the most interesting there was the higher numbers relative to the rest from Victoria moving, but I think you'll find moving interstate, I think you'll find a lot of that's heading into southeast Queensland from Victoria, which was already a strong source of interstate migration, southeast Queensland. But I'm not sure, for various reasons we've discussed, that we are going to see a significant increase in population in regional centres, even though we do have more work from home, I guess, is an accepted process given what we went through last year. There still lacks infrastructure and various bits and pieces in rural settings, even larger regional areas, and that'll take some time to catch up to what the city does offer. I'm not saying that we won't see some growth, but I don't think it's going to be mind-boggling growth as been predicted by many. And just another thing you mentioned before about investor activity, Michael, if I could just change tack quickly.
Sure.
I'm not sure we're going to see increased investor activity, not as market share. I think investors will rise as the market rises, the number, but I don't think we're going to see a return to those very high proportions of investor activity we had in the previous strong growth period in 2015-16. I think banks are still quite reluctant to lend to investors. I also think there's not a lot of choices we had in previous strong investor periods in terms of what to buy. And those periods were driven by apartments, Michael, particularly obviously in Sydney and Melbourne. And we're seeing an overhang from that now. So I don't think we have the apartments, obviously, which are a negative for investors at the moment, to fuel the sort of investor boom that Westpac are predicting, which would bring in APRA. So I think they're off the mark there as well. I do think investors, however, will be looking for higher yielding detached housing, established detached housing. I think the savvy investors will be going after that. They know there's going to be prices growth and plenty of demand in terms of tenants for those types of properties as well. But I don't think we're going to get the boom investor activity that we had in previous price upswings, Michael.
Well, it would be unfortunate if it got to the 50% the rate
Yes.
of investors
Yes.
like there was in
Yeah.
2015,
Yeah.
16. That's unsustainable.
Yes.
But you also made a point a short while ago, and this chart now shows the challenges that certain segments of the market, particularly the Sydney and Melbourne inner
Yes.
city markets, have got.
Yeah.
There's a glut of apartments there. I know your data from My Housing Market shows there's currently over 23,000 units listed for rent
Yeah.
in Sydney and over 20,000 units vacant in the Melbourne area.
Yes, Michael. I mean, we've seen that for more than a year now, the high vacancy rates, but it's really now, or it has been impacting rents for the most part of the last year. Rents are down quite substantially now in Melbourne and Sydney for units. And when we look at some of those inner suburban, inner CBD areas, they're down nearly 30% rents. And that's quite a
Mm.
significant fall. But what's interesting with the latest data, Michael, is we're now starting to see prices falling in those areas as well. Those markets have sort of held up over the last year. There's still been buyers interested, downsizers, empty nesters, and first home buyers still interested in those inner city apartments. But look, I think the worst is yet to come. I think once a lot of those investors who are still on the mortgage holiday schemes, once they move off that, they're going to struggle to meet their outgoings, which they are now. And that'll mean more properties offered for sale in those areas. And I think that'll mean lower prices. And we are talking significant numbers of actual units that will be on the market, Michael. So I think there is more downside to price declines in those inner suburban areas in Melbourne and Sydney. And, not a good time for investors. They're not just struggling to get a tenant or maintain their rents, but also looking at their capital value declining sharply as well. But it is a product of what was strong development in those areas back in the previous boom, as we just discussed. But it's been exacerbated by the credit squeeze on investors and also by the coronavirus impact of closed borders.
Sure. But let's finish off on a good note because
Yes,
the Australian economy is bouncing back
yes,
quickly from COVID-19. Both unemployment and
yeah,
underemployment have continued on their
yeah,
downward trend, and the official jobless rate dropped from 6.6 to
yes.
6.4 in January. And the ABS has estimated that 93% of the jobs lost during the peak of the corona wave have actually now been recovered.
I don't want to sort of keep saying we told you so, but we did tell you so, didn't we? But I think we may get a 5 in front of our unemployment rate this year, Michael, even though you've got the horror, and I'm being, I guess, a little facetious here, the horror of the end of JobKeeper in a month's time. I don't think that'll be a blip on the radar. But yes, good numbers, 6.4. In terms of jobs growth, that's still quite strong. I think we're now just 59,000 jobs fewer than our pre-coronavirus total in terms of the workforce. And considering I think we were up as high as a 900,000 person loss at one stage, and we're now back to just 59,000 down, it just shows what a great comeback the Australian economy has made. And of course, our participation rates are just still tracking at near record levels. So it's not about people having given up looking for work. The proportion of our population in work or looking for work is at record levels, and we're seeing sharp declines in unemployment. We've got a way to go. We want to get not just into the fives, Michael, we want to get into the fours. But if we can get into the fives this year, I think it'll be a fantastic result.
Well, of course, the reason we want the unemployment rate to go down is so that wages growth goes up.
Yes.
But the great news is this has recovered so much quicker than it has in previous downturns and previous recessions, as has the economy. So really, we've had that V-shaped recovery that very few people thought was going to happen.
Yeah, and that's because it was a black swan event, Michael. It really wasn't something that was, I guess, inherent to instability in the economy. It's come, it's been adapted to, and we all move on. Our economy wasn't doing great prior to coronavirus. That's why our interest rates were so low. But this was just a matter of, I guess, experiencing the lockdown scenarios, getting over it, adapting to it, and moving on. Quite similar to our housing markets, they've just really moved from that pause in activity caused by coronavirus. Once the pause was behind us, we're now back to our sort of normalized economic environment. And of course, there is still some catching up to do. We're not trying to overgild this lily, Michael, but we're well on our way to getting back to where we were prior to coronavirus. Probably a year or more to go before that happens. But it's been a great result. And to be talking about a 5% unemployment rate, perhaps in 2021, considering we were supposed to get to 10 or even 20% unemployment rate, according to a number of commentators and government officials, which is a little concerning, is once again, it shows how resilient and robust our economy is, as well as our housing markets.
It's also good to remember that it hasn't even been a year. This is
Yes.
February. It really didn't. This is when we first started to understand that it was going to affect our shores. And here we are. We've had the downs, we've had the ups, and I think we've got a good year ahead. So I look forward to catching up with you each week, Andrew, and chatting about the news. Look forward to catching you next week.
Thank you, Michael.